It has become necessary to revise the 2024 macroeconomic framework due to recent domestic and global economic developments, including the impact of the debt restructuring. Mr. Speaker, key revisions to the macro fiscal targets for 2024 include overall real GDP growth rate revised upwards from 2.8% to 3.1%. Non-oil real GDP growth rate is revised upwards from 2.1% to 2.8%. Growth in GDP deflator scaled down from 20.2% to 17.5%. Nominal overall GDP has been revised from 1.050 billion Ghana cedis, that is 1 trillion Ghana cedis, to 1.020 billion Ghana cedis. Non-oil GDP has been revised from 979 billion Ghana cedis to 977 billion Ghana cedis. End-period head inflation remains unchanged at 15%. Primary balance on commitment basis is maintained at a surplus of 0.5%. And gross international reserves, including oil funds and incumbent or pledged assets, to cover no less than 3 months of imports. Mr. Speaker, accounting for these developments, the revision of the 2024 fiscal framework indicates that the primary balance on commitment basis remains unchanged at the targeted surplus of 0.5% of GDP, in line with the IMF-supported PCPEC objectives.
You agree with me that typical of this government, this address was uninspiring, bereft of new ideas, gives no hope, and fails to offer a roadmap for addressing the numerous problems facing the people of Ghana. This media review leaves many people disappointed and uninspired. It gives no hope to the people of Ghana, and that anything this government had said and have done over the last 7.5 years, they've done nothing to reverse the negative trend. In the last 8 years, the Akufo-Addo Bawumia government have burdened the ordinary Ghanaian and businesses with a number of taxes, making Ghana a high tax regime. These taxes include e-levy, COVID levy, an effective VAT rate of about 22%, a distorted value-added tax regime, a bad-tin tax, a baller tax, in other words, a sanitation levy, a high tax on petroleum product, an emission levy, a high import taxes, burdensome fees and charges across all sectors of the economy, and over 40 new taxes in the last 7.5 years. These burdensome taxes have made Ghana unattractive for investment and foreign direct investment. As a result, many Ghanaian businesses are relocating to Togo and Ivory Coast, among others. In fact, last week I heard of a company moving from Ghana to Benin Republic. Ghana has lost so many jobs opportunities as a result of the relocation of these businesses. This adds to the already high unemployment situation due to the fact that the government has failed to create new jobs.
Those are snippets of what happened yesterday in Parliament as Dr. Mohamed Amin Adam, the finance minister, delivered the mid-year budget review. And you also saw just shortly reactions from the minority saying that this was hopeless by way of a mid-year budget review. But what is the way forward? No new taxes introduced, but from 2025, road tolls to be reintroduced, no additional expenditure. If you look at expenditure on a cash basis and the deficit, you would notice what is happening. A new Labour bill and prioritization of road projects. We'll be getting into the salient matters on the mid-year budget review. But let me introduce my guests first, and then I will go through those salient matters with you. Joining us for a conversation, we have Seth Terkper. He is former Finance Minister. Dr. Theo Acheampong. He's an economist and political risk analyst, and later will also be joined by GUTE's president, Dr. Joseph Obeng. But let's go first to the salient highlights that we have pinpointed for you, which I'll be running through, and after that, I'll bring in my guests on some of those salient matters. But gentlemen, a very good morning to you. Thank you for joining the conversation.
Good morning.
Good morning to you in the studio, and good morning to your viewers and listeners.
All right, Dr. Theo Acheampong and Seth Terkper, thank you very much. I'll walk you through some of the salient bits, and then we shall get into the conversation. So just the very, the start of the conversation, no new taxes introduced. Road tolls, like I mentioned, will be introduced in 2025, and a cut in expenditure. Then you look at real GDP for 2023, 2.9%, non-oil 3.3%, and then inflation dropping to 23.2% in December from 54.6% in 2023. In terms of our reserves, and I'm just picking the most salient bits, in terms of our reserves, by June 2024, reserves had increased to $6.9 billion, equivalent to 3.1 months of import cover. And though the finance minister said the cedi had depreciated moderately, marginally, we do know that it had depreciated by 18.6% in the first half of 2024. You look at the overall budget deficit on a commitment basis, you're looking at 17.5 billion Ghana cedis. If you look at the overall budget deficit on a cash basis, you're looking at 27 billion Ghana cedis. Other relevant information to take a look at, we'll be looking at all of them, but then if you actually look at the public debt by end of year 2023, of course, we stopped making payments on interest. It is 608.4 billion Ghana cedis, 608.4 billion Ghana cedis, and end June 2024, 742 billion Ghana cedis as projected. That's an increment of 133.6 billion in 6 months. Let's bring in our guests now. Seth Terkper is former finance minister. Your end of parliament described the mid-year budget review as hopeless. Those were some of the words that were used, among others. What is your reaction to the mid-year budget review, at least what you heard?
Thank you very much, and permit me to put this in the context also of the fact that we are still in an IMF program. And this is actually the final verdict, of 8 years of the current, government. And I think that should be the point from which we should be evaluating the economy. Let me also mention that if you go to the Ministry of Finance website, we are bereft of information. The last update is June of last year in terms of fiscal data. There's no information on debt, and there is no comparative figures in terms of what we are talking about. We are in an IMF program, and I can't recollect, out of the 17 programs, a delay. First, there was a delay in even releasing the scanty data that comes with a mission when they're in town. There is still a delay in the release of the full IMF report. There's no information on debt on the website and other critical information which are legal, legislative, and should have been tabled in Parliament and also published.
Well, we'll leave the parliamentarians to deal with that. It's legal and it should have been published. But doesn't it suffice when you look at the public debt? I just want clarity here. He talks about the end of year 2023 figure, 608.4 billion, and end of June 2024, 742 billion Ghana cedis, an increment of 133.6 billion Ghana cedis in 6 months, and there are other projections there. Does that not give us the details we need?
we need to know, and this is where you can go to the scanty information that they have found attached to the board meeting. And it's, if you express it in terms of percentage of GDP, even by 2029, and it has been extended by 1 year. The original projections were 2028. That is what we should be concerned about, because it shows that we'll be just shy of 70% by 2029. That is the projection. And in other periods, it's much higher. This is not going to take us, to the markets, and therefore, does it mean that we'll continue to be relying, on treasury bills to finance the economy? We started using treasury bills almost exclusively since May of last year. It's a year now. And since we do not have, all that we've been doing is refinancing for most of that issuances that are being made. It means that we are turning. We have turned the first, bills that were issued into a 1-year loan already. And this is exactly what happened up to 2015 when we had to refinance. And as you rightly pointed out in your intro, when you look at debt, there's a lot that's been suspended, which is waiting for future governments and future generations. And I think that is what we should have been hearing from the minister in terms of what is the path, for us to open even our own domestic bond market, which is decimated, for which there's been no apologies for the haircuts and whatever as a final, major economic document. So I think this is the point. Giving us nominal figures doesn't give us the context, in which, we should be making the analysis. And you can, for example, you mentioned 3 months of import cover. Your coverage was more precise. And this is an issue which has been a difference between the government and even the IMF, not including our oil revenue in calculating the import cover. So I can go on. Inflation,
are you suggesting that was what was done? I'll move on to my other guest shortly, but are you suggesting that was done, and that means that even some of these figures we've put out, including import cover and all of that, are not accurate? Is that what you're saying?
I'm saying that they are, yes, in terms of the method of calculations, because they are special reserves. And in our own laws, we do not include them in the import cover. So if you are comparing, for example, the current performance with past performance, you are not being, fair. The analysis is not being, and then it also makes us complacent. And I think there's a lot that is making us, complacent, which we should be. Probably we'll discuss some of them as we go along.
Yes, but just clarify this point for me. You say the law stipulates that some things ought to be done. Is that to say that the finance minister and the finance ministry are engaging in illegality by not putting what you would call accurate information out there, both on their website and also, like you're referencing, even in terms of our import cover? Are they engaging in illegality?
To the extent that it's not published. That's what it is. From debt to ESLA to, oil revenues and the rest, they're supposed to be published. And the means of publication includes being put on the website and also on other, in the daily newspapers and the rest. So if you have seen it, I have not. And that is the context in which I'm making my point.
Okay.
And you can Google, you can let your producers Google even before we leave. Try to get any information on debt, which used to be put for past years. Try to Google for any information on the fiscal situation, including even the budget that has been read on the Ministry of Finance website. I'm saying this because this is what we need for regular analysis, and that is why these have now been put in the Public Financial Management Act.
Thank you.
So in sum, I'm saying that we even lack, adequate information to be able to come to a firm conclusion as to where we are. And we can later on come to other issues like inflation and the rest, which
we will come to them.
Still at a very high. Yes.
We will come to them, Doc. Let me also acknowledge the presence of Dr. Joseph Obeng. He is president of the Ghana Union of Traders Association. Dr. Obeng, good morning. Do we have Dr. Obeng on the line? Dr. Joseph Obeng, good morning. You would have to unmute so I can hear you.
Good morning.
All right. Thank you for joining the conversation. Let me also bring into the conversation Dr. Theo Acheampong. For you, what is your basic understanding of what happened yesterday? Did you get what you were expecting from the finance minister? Some of the thorny issues have already been raised by Seth Terkper. For you, what is your reading of what happened yesterday?
Once again, good morning. And I think there are different issues that we need to unpack from the growth story, or quote unquote, what the government likes to call it, the turnaround story, and some of the numbers sort of underpinning it, to a number of the issues that as Uncle Seth highlights in relation to, for example, the debt financing and things to do with what we've got to do to build a more equitable and robust, right, economy that actually creates jobs, going forward. So how do you bring in the SMEs? How do you ensure that the private sector, for example, has access to credit and there's liquidity to support that? So that's sort of the approach that I like to take it from. And if you take it from the first strand of where we were, say, 2 years ago, with a very severe crisis and a lot of the economic indicators going in a negative direction, vis-a-vis where we are now, where you look at, for example, the inflation figures now, I think it's around 23 or so percent, still high, and nowhere near the 15% end of year target. You look at the growth figures that have come in, and quarter, we seem to have some uptick or momentum on growth. And you look at, for example, reserves and other indicators, you could, on the surface, argue that at the macro level, using those indicators, there seems to be relative stability. But there are major issues or major challenges at the micro level, and especially when it comes to how you deal with the cost of business and borrowing rates and borrowing trends, and even how the government is going to finance its budget obligations, going forward, and at whose expense or cost. So if you take, for example, on the financing bit, it's good that the government said in this supplementary budget that they are not going to they're not asking for any more money. And that's really on account of the fact that there are some deferments they are getting on the expenditure front, and then also the interest savings, and then a little bit on the revenue side. So revenues were down, but if you look at the numbers that were accompanying the mid-year budget in paragraphs 57 and 58 of the document, you see that there's a bigger cut in expenditure vis-a-vis the revenue. And then you also look at the actual financing, right, of the deficit. And this is what gives me a bit of cause for worry. So you look at paragraph 22, paragraph 60 of the mid-year budget, and basically almost 72%, right? So 7 cedis out of every 10 cedis that the government is going to borrow to finance the deficit is going to come from the domestic market. So government will still be issuing treasury bills and other instruments. And like Uncle Seth was saying, this then means that they still have to pay very high borrowing costs. But not only that, it actually also means that businesses such as the one that Uncle Joseph has would have to compete with the government for the same liquidity or capital to do their business. And that is very, very challenging for businesses in terms of getting access to capital and liquidity, where borrowing rates are still well in excess of 70% going forward. And then also then means, as we all probably are aware, for me, the government cannot go to the international capital markets probably not until 2028 or 2027, thereabouts, once we finish this IMF program. So the whole growth story of what you're seeing at the macro side is still not being fully reflected at the micro level because of the constraint with access to capital. But number two, also because of the very high tax environment that we still find ourselves in. There are a number of tax handles that many businesses complain and have complained about. And of course, the government has to make a very difficult choice of, the trade-off between those tax revenues and bringing them down so businesses are able to compete. Then there's also the CD, the exchange rate story, in all of this. I think the finance minister said, compared to last year, the depreciation has been much slower, the same period this year than last year. But for me, it's neither here nor there. When you still have your currency losing by a mid-year point close to 20% of its value, that is problematic, So it's like asking us to debate or go down, the worst path, which I actually don't think it should be the case. People want stability, and when I have to change almost 16 cedis to get $1 to be able to either import or to do other things, again, that would have a major impact on growth. So I think overall, what the story from the media budget tells me is that you've got some relative stabilization, yes, but it's still not being fully felt in bread and butter issues. It's not being fully felt in the business environment, and people are still struggling to be able to sort of make ends meet. One or two proposals in there that I think quickly is quite useful is and it's actually part of the IMF conditionality. So the amendment to the Fiscal Responsibility Act to put in place, which was actually set aside during the pandemic, that's going to come back by the end of this parliament. That act to come back with a revision to the rules, the deficit rule, and then the debt rule, as well as strengthening the fiscal council to have an oversight on some of the spending parameters. I think that that's a good thing, and that's commendable. And then also there was an attempt in the document to talk about housing and trying to do something with housing and supporting SME growth. But these are more long-term measures that is not going to immediately have an impact on the economic prospect of the country. And I think that in the substantive budget that will be read in November, we may get a bit more detail around issues with housing and then on other issues to do with supporting the SME sector of the economy and like roads and things like that.
All right. Thank you, Dr. Theo Champo. Let me bring in Dr. Joseph Obeng. Some were expecting that taxes would be shaved off. None of those were shaved off, but in fact, there were no additional taxes either. Did that make you happy, Dr. Obeng?
Yeah. Our experience have shown that the media budget do not normally touch on the substantive budget. It's only for a supplementary budget or revise some of the targets. So in that aspect, we were not expecting those reliefs, tax reliefs from the media budget. But like Dr. Theo said, the mainstream, we put our major input into the mainstream budget on November. That's where we can actually make an argument. Fortunately, all the political parties that we've made it clear that we cannot go on like this. And
hello, Dr. Obeng.
So
accepted the fact that cost of doing business is very high, taxes are numerous, and all are prepared. Hello? Hello?
Yes, you
Hello?
can go ahead. You can go ahead
Hello?
now.
Hello? Hello?
We seem to be facing some challenges with the connection to Dr. Obeng. We'll go back to Seth Terkper, and as and when we have Dr. Obeng back, we'll get back to him. Mr. Terkper, so there's an interesting bit in here, because if you look at our debt situation, end of year 2023, 608.4 billion, end of June 2024, 742 billion Ghana cedis. That's an increment of 133.6 billion in just 6 months. So the question then is, how concerned are you about our debt stock? Some project debt to GDP over 100%. What are your reactions? How concerned are you, Mr. Terkper?
If you permit me, I would share, the situation as projected by the IMF. But, as I said, the situation facing us with debt, there are three main or four elements which I like to highlight, and probably I would open the why someone is doing a contribution. First of all, I mentioned we are nowhere near the 50 or 55 to 60 or 65%, range, which would be of some comfort in terms of preparing, together with other indices, to go back to the markets, external markets, which are very critical at our stage of development as a lower middle income country, which will be losing concessional financing and grants. Secondly, the debt profile, as projected by the fund, shows clearly and updated to 2029, shows that from 2026 actually, the suspended interests and debt payments will begin to fall due, in line with both the bilateral creditors and the now being negotiated commercial creditors. Even though it's not been published in full, some information that is coming out, being leaked out, gradually shows serious bumps from 2026 through 2020. That's a year, after any new administration. And then, thirdly, when we come to our own domestic market, there are delays in even meeting the commitments, post haircuts. And the domestic markets financing is tough, for the government, in that it is depending on short-term notes and bills, treasury bills, 2-year notes, and the rest, which in principle are actually meant for liquidity management. They are not meant to finance the capital budget, for example. And I say this because when we use some of these to finance, even in terms of 3-year and 5-year bonds, to finance the single spine doomsday, recall that we had to quickly stop the borrowing and negotiate with labor, and look for other solutions like ESLA, to move away from borrowing to meet these short-term commitments and long-term commitments of government, including IPPs and others. There was a tax of ESLA. So in a gist, I'm saying that we have been extending, the tenor, what you call the tenor or the duration or the maturity period for our debt as a conscious policy. And governments, in fact, the current government, as a result of that background, the setting up of the sinking fund, which I understand is to be reinstated and the rest, so that we would reach where we want to, we were able to even issue, the current government as well as the JM administration started issuing even forex, denominated bonds, which non-residents, not just Ghanaians, and Ghanaians were patronizing on our Ghana Stock Exchange. So this is the edifice that has collapsed. And I would have wished for a structural explanation of how we are going to bring these, markets, back. The cut in expenditure is belated. Sorry, is delayed, but welcome, because you would note, that this has come about because of the inability to increase more taxes. And I think as a nation, we need to be reflecting, of the fact that we need to reverse the debt situation, because I have said it, I believe even on the show, that this is the second major debt episode that this country is going through. HIPC was the first one, and it came with forgiveness of a significant amount, of the debts, that we owed, from about 150% plus to 28%. Some data put it at, 30, 35%. But that is significant forgiveness of the debts. And despite having more resources in terms of oil fields, increasing it from 1 field to 3, and then increasing output from about 70,000 barrels per day to nearly 200,000 barrels, per day, we find ourselves in a situation where we are not being totally forgiven. There's some haircut, which is forgiveness, now including citizens, right? And as a result of which we have some relief. I would advise that we should be including on an accrual basis the debt that we are suspending to give us a better picture. It is still a liability which must be paid, and therefore excluding it is the very reason why we started accounts payable module, which was to have gone into the GIFMIS from 2017, but was not done. And today it is an IMF conditionality. Do we have to wait for IMF to make everything a conditionality, including, initiatives which we start, ourselves?
Right.
So, in fact, in some, I don't think we should be gratified at all with the debt situation in which we are. There is a big hump that is waiting for us, just as there was that big hump waiting for us in 2014. We started a single spine. And that hump was the fact that, His Excellency President Kufuor's bond was going to fall due in 2017 without any preparation to pay principal. We were paying only interest. And so let me pause at this stage, and this is my reading of the debt situation.
Right. Let me see whether I can get Dr. Obeng back on the line. Dr. Obeng, can you hear me?
I can hear you, Claire.
Okay, the connection was bad for a moment. You were telling us about how you felt about non-addition of taxes, which is to be expected, but also non-scrapping of existing taxes. Your take?
Yeah, so that's what we're expecting. That we're not expecting that the old taxes are going to be removed. That was obvious, and that our major input will be made in the mainstream budget to be held on November. But if you look at the economic report that was given to us, the figures, some of them very positive, but all that we seek is the stability of the local currency. It's very important to us. So whatever...
Dr. Obeng?
Measure that they have done them to... Hello?
Go ahead. I can hear you.
So we want them to make every effort to sustain some of these gains with regards, especially with the stability of the local currency. It's very important to the business community. And then also, we are very, they provided some mitigating factor in the SME growth and opportunity. The funds that they provided, we see it as a mitigating factor, but these funds should be directed to targeted areas so that it will have a positive effect on the economy. And we think that overall, if you look at most of the figures, even with the debt restructuring and all that, we've come this far. And it can be said that it is inspiring some hope and confidence into the system. But all that we need is to make every effort to sustain this growth and even enhance on the local currency, and then also bring the inflation further down so that businesses can have the respite to grow again.
Let me bring in Dr. Theo Acheampong. Two issues from where Dr. Obeng left off. The cedi, he wants stability. You mentioned, I mean, I believe you are the one who spoke about the cedi to the dollar being what? Requiring 16 cedis to exchange for $1, and of course 20 plus for a pound. The cedi has depreciated by 18.6% in the first half of 2022. How does that reflect on our IMF program and the stability of our currency moving forward? And I want you to tie that into the commitment and cash angles of our overall budget deficit. You would have heard the finance minister suggest that we are spending within budget. We are in fact underspending. If you look at the overall budget deficit on a commitment basis, it stands at 17.5 billion Ghana cedis. On a cash basis, 27 billion Ghana cedis. What do you make of these 2 points?
Okay, yeah. So let me start with the deficit one, and then I'll come to the cedi one. And actually, to leverage an important point that was made by Uncle Seth in his submission, if you look at the June 2024 IMF report that they issued for Ghana off the back of the second review, it is very clear, and we have to be very emphatic on this, that the 55% debt to GDP reduction that we are looking at overall, by the end of the program in 2026, is not going to be met. So the public debt numbers that we've got on a gross basis from the IMF, actually the projection is that by the end of 2029, we would be doing about 66.9% debt to GDP. And by the end of 2026, we will still be at about 76% debt to GDP. Of course, it's still a reduction compared to almost like 100% at the end of 2022, thereabouts. But it does show you that even with the restructuring of the debt that we've got going on, both the domestic one and then the external bilateral and the external commercial, which we're still waiting for the consent solicitation and the offers and all of that. The idea of meeting or getting the debt down to sustainable levels, in this case below 60% debt to GDP, is not going to be met according to these recent projections that the IMF itself makes. So the implication really of that is that if you want to still push much forward to actually meet those targets, right, you've got to either cut back on your spending, or the economy grows fast enough such that your GDP becomes much bigger. And then when you work out that metric, the number comes down. But at the moment, as we speak, that 55% debt to GDP target by the end of 2026, when we exit the IMF program, is highly unlikely to be met. And I think that is also partly what informs the numbers that we've seen in the mid-year budget, where the fiscal framework and the commitments that we're seeing basically then means that the overall balance is still come down. So you're right that on a commitment basis, I think it's been revised from 50 billion or 4.8% of GDP down to 42 billion or 4.2% of GDP. And then the primary balance also on commitment. Commitment shows you all the projections that you have made going forward and the things that you have to pay 2024, we actually have a positive primary balance. In other words, when you take out your revenue and you subtract the expenditure, but you don't account for debt servicing costs, you actually have a positive, primary balance in that context. But the biggest thing from all of that is that the financing of it, like I said very early on, is still largely going to be driven by government borrowing from the domestic market. And that puts a lot of pressure on liquidity. And then on the question of the cedi, that is absolutely critical for almost everyone, right? Not just traders, because that drives inflation expectations, that drives the cost of doing business, and even some of the tax handles that the GRA and others, collect at the port. Because when you bring your goods in, a lot of the things on the ICOM system is actually dollar converted into cedis. So when you're having the depreciation almost 18-19%, it then basically means that you have to pay more taxes at the port, and ultimately you're going to pass that on to consumers to also pay, and that drives a lot of the inflation expectations and things like that. Commodity prices have been relatively modest, but if you look at our capital accounts, so the trade balance has been largely positive for the last few years, but where we're also losing a lot of money actually comes from the capital accounts, where you have a lot of the portfolio inflows. And I've heard suggestions almost to the point that we should institute some capital control measures and things like that in an attempt to retain more of those dollars in the system to show up the cedi. I don't think that would necessarily work, and actually would end up, having more negative impact on investor expectation than we expect.
Let me ask you, though, just a quick one. I'll pose that question to Seth Terkper as well. If you look at our old targets versus the new in terms of the macroeconomic indicators, real GDP growth, the old target was 2.8%, has been revised upwards to 3.1%. Non-oil GDP growth from 2.1 to 2.8% per the latest review. End period inflation, 15%, it's being held. And then primary balance as well, 0.5%. Are these realistic, especially the first two, real GDP growth, non-oil GDP growth?
Yeah, absolutely. I think we've seen an uptick and a momentum within the economy, and I think those numbers very likely to be met. I actually think it may actually end up, we may end the year with a slightly bigger or higher number than originally, forecast, and even the revisions that have been made. So the GDP growth numbers very positive, but you can actually see that some of the other numbers that are in the projections in terms of the end period inflation figure of 15%, I doubt that we'll be able to meet that. And then the reserves of 3 months of import cover, yes, but there's a technical definition of that, and I know it's one of the sticky points between, even in the IMF program, do you include your encumbered and pledged assets as part of your total reserves, or should you be reporting the net reserves? But that's a technical question. But I think overall, yes, the GDP number is very highly likely to be met. Inflation, I have my doubts on that. All
right. Thank you very much. So we're wrapping the conversation, gentlemen. If you look at the balance deficit, it's also been reviewed downwards from 50.26 billion Ghana cedis to 42.5 billion. But as I take your final comments, I also want you to factor in the fact that in election years like this one, there is a tendency for government not to rein in spending. In 2016, under an IMF program, somehow, Seth Terkper, you were able to do that, to rein in spending so that you didn't exceed your spending. What are your expectations? Do you think this administration can rein in spending ahead of election 2024? And gentlemen, then you add your final comments. I'll start with you, Seth Terkper.
Thank you very much. Yes, we are able to do it, and basically, as very important to reduce expenditure, and that's where the difficulty lies. Because, as Dr. Ben said, we are even expressing satisfaction that there has not been any tax increase, which has been almost successive every year for the last 8 years, which is welcome. But that deprives us of revenue, and programs like ITAS have not been put in place to supplement ICOMS, the administrative end of tax compliance. And therefore, that's why we keep relying on levies. And the levies needs to be actually phased out in a structural, manner, because otherwise we are going back. All these levies used to be be in existence and were subsumed under the VAT. There were about 18, or so levies that were subsumed under the VAT, baby ones, and the rest. On the growth point, the irony is that we are going to 2016 numbers, despite potentials like 3 oil shares. In fact, the 3.6 was on the old basis, the deficits that occurred as a result of the shortfall of crude prices and the rest and the revision of the budget. The 2.8 is on a new basis, exactly where we were in 2016. So it's a lost opportunity. And therefore it means that we have to do more, because growth can bring in revenue, reduce the deficit, and impact debt. And therefore that is a sequence. And then impact debt, reduction of arrears and all of those things, so that we'll be able to get back to using medium and long-term instruments to finance the budget. And that would also ease the squeezing out, which Dr. Tio Acheampong mentioned, in terms of the crowding out, rather, of the private sector and the exchange rate. I think is something we have to work hard on, also on a structural basis, reclaim some of the Galamsey land for cocoa production to increase, and many such, measures. And that would also impact the exchange rates, obviously. So in sum, what I'd like to say is that we need to start looking at deeper structural measures, over the next, beyond the program, to what the fund itself has projected to 2028, 2029, as Dr. Tio Acheampong mentioned, and introduce many significant structural measures, stabilization fund. Let me make a last point. The issue with which Dr. Tio Acheampong said was technical is that if you assume that your oil revenues are part of your import cover, simple explanation, you are assuming that they are available for imports to support DOC's businesses and the rest, particularly, for consumption. And therefore, it means that you are being flippant with the purposes for which they were established, to set up buffers for the economy, to set up, funds, repayment funds, to reduce the debt level, and then prepare for contingencies, like the flooding and others that occur. I think that's a simple explanation. And that is why, so long as it is in law that they must be used for these purposes, you can't come back without amending the law and treat them as available for regular imports.
Okay. Thank you so much for those thoughts. Let me take the thoughts of Dr. Tio Acheampong as well. On that matter, your expectations in terms of rating in spending, and also any concluding thoughts you may have. Takeaways.
Yeah, so I think on the spending front, the numbers so far indicate that it's been contained. And I think also because the IMF is more or less around, I don't think that we're going to overspend this year. I don't see, that happening. I think the bigger point which Seth and others make really is, how do we deepen the reforms and use this opportunity that we've got to restructure and turn around the economy to be more responsible with our public finances, to ensure that we actually spend the money in the areas that are growth enhancing, can create jobs and ensure that you actually have a more robust and equitable economy that works for every Ghanaian. That for me is the paramount, objective, and this has to be done across party lines and across institutional lines. Other than that, some of these small gains that we're celebrating will be here, and we actually end up going for our 19th and 20th program in the next few years.
Interesting thoughts. Thank you very much. Dr. Obeng, for you in the business community, are you expecting government to be able to check spending and ensure that we don't end up in more turbulent waters? What are your final words for us?
Yeah, most of our programs of these numerous taxes is as a result of excessive expenditure. And that, if it is controlled, is going to help us. Because if you overspend, then you have to go and find the money. And where do they get the money? They have to come to us and with more taxes. So it's very important that we control our expenditure. And that's why I was happy that the finance minister did not come for supplementary budget, and that he says he's going to work within his limit. We should avoid the temptation, even in this election year, not to throw the economy out of so that we can have a stable environment. Businesses thrive on stable environment, and then the stability of the local currency is very important. And most of these things are tied with expenditure. So it is very necessary that we do everything to contain the expenditure so that we can also have the respect to grow as businesses. Yeah.
Well, thank you very much for joining the conversation, gentlemen. We had Seth Terkper, former finance minister. Dr. Joseph Obeng, you just heard him. He is president of GUTA. And we also had joining the conversation Dr. Theo Acheampong as well, an economist and political risk analyst. Thank you so much for adding color to this conversation. But from